Ticker symbol VRSK is up around 20% in the past year, and today we'll be looking at a stable company with high dividend growth, which has low but consistent revenue growth, as they have been managing to grow this revenue in the past year by 7%. This company's net margin is highly variable, meaning that it changes a lot from quarter to quarter. So today we'll be looking at VRSK Analytics, a data management company for the insurance industry. In their annual report, they state that they are a leading data, analytics, and technology provider serving clients in the insurance ecosystem. They basically analyze billions and billions of records to offer predictive analytics to clients in the rating, underwriting, claims, and many other fields. The way they do this is by offering different solutions such as proprietary data assets, expert insights, statistical models, tailored analytic objects, and robust software platforms. These proprietary data assets are their biggest asset because these are essentially databases that they have been able to build over the past 20-30 years, containing so much information about different insurance aspects, everyone that requested a claim, and all the different data that allows them to then perform these predictive analytics to help insurance companies. Basically, they facilitate the way that insurance companies can predict whether a client will actually need a payoff for their insurance or not. And this is key to insurance as it allows them to actually choose which clients they will undertake and which clients they will just not enter an agreement with. And now the growth strategy that they develop can be divided into 3 different sections, starting with them being able to drive consistent and predictable growth, ensuring disciplined capital allocation. Here they're prioritizing internal investment, which is great because they believe that they can obtain a higher return just by investing in themselves and growing organically than going outside and seeking an M&A transaction. And finally, number 3 is that they want to enhance operational efficiency and profitability. And what this basically means is that they want to get these margins under control. They want to reduce the amount of costs that they need in order to fully operate as a fully grown business. And the fact is that this company gets extremely interesting when we look at their financial analysis. They currently have a return on capital employed of 41%, and this actually makes sense of why they want to prioritize internal investment over M&A transactions. Because this means that for every dollar that they invest in their business, they get a huge return just from organic growth. And just for you to actually put this into perspective, our threshold is usually around 15%. They have a very high interest coverage ratio, an acceptable cash conversion ratio of 80%, solid profit margin of 70%, and a very nice operating margin of 33%. But as I told you, this operating margin is varying from quarter to quarter by a lot. As we can see here, their financial analysis, you can see that their revenue has been growing at a consistent pace and their gross margin has stayed pretty solid. However, their net margin went from around 50% to 20% in 2 quarters starting 2023, and now it has consistently risen just above 30%, which is solid, but it makes you wonder, if their net margin actually decreased by 20% in 2 quarters, what is stopping from this actually happening again in the future? Now, their efficiency ratios have been very consistent and rising at a small rate, with the return on invested capital sitting at around 30%, and now their return on equity has increased a lot, but this is mainly caused by their equity actually decreasing. Now, when we look at their leverage analysis, we can see just this. They used to be very asset heavy, and now these assets have actually decreased at a very, very fast pace, and now their current ratio has increased a lot. One thing to note here is that the return on capital employed that we discussed, yes, it's 41%, but this is heavily affected by this reduction in total assets. As we know, return on capital employed is calculated by dividing your profits between all the different assets that you used in order to make those profits. And since these assets are decreasing at a very high pace, this can increase the return on capital employed without it actually being true. But when we look at their fundamental analysis, this company gets a solid 5 out of 8 ticks, as first of all, they have low liability risk, they're able to generate extremely consistent cash flows, and they pay out a dividend and even conduct share buybacks, which is great as they're focusing on redistributing these free cash flows back to the investors. And now the 2 most important points in this slide, pricing power and existing moat or competitive advantage, are met by VRSK Analytics. To me, having pricing power is generally defined as being able to raise prices above inflation without actually losing a lot of customers, and I believe that VRSK has this ability under control. as they provide so much value to insurance companies that whatever they increase their prices to, these insurance companies will actually understand and will still make a lot more value compared to what they're actually paying in order to use these solutions. One thing to take into account here is that these costs are generally peanuts in comparison to the money and the other costs that insurance companies are managing. So this is why these will usually go under the radar, and VRSK will be able to increase their prices above inflation consistently. Number 2 is their existing mode and competitive advantage, and here I'm mainly going to focus on their proprietary data assets. These are extremely tough to find, they're extremely valuable, and in order to have these for very niched down industries, so for example, they have databases about the energy insurance industry, which are extremely hard to find, are not composed of public data, and you can only have these if you've been in the business for a very long time. This generates a lot of value for insurance companies, and it is the main thing that keeps them coming back to Verisk Analytics. There are 3 main things that I didn't quite like about the fundamental analysis, starting off with their solid balance sheet. And this is because their assets have been decreasing at a very fast pace, their equity is starting to wiggle about into the negative territory, and additionally, they do not have organic free cash flow growth, and the portion of their revenue growth which is organic is quite low, so I would not give this a tick. Now, when we move on to their dividend, they're paying a 0.53% dividend yield with a 23% payout ratio, which is pretty solid, and it also allows them to focus all of their cash and invest it back into their operations, as we stated previously. But when we look at their valuation analysis, this company has been trading all over the place in the past 3 years, and it now seems that they're a bit higher above the average of the past 4 years, trading at around a P/E ratio of 40 times, which to me seems very high for this company. Now, when we look at their free cash flow yield, they yielded 2.31%, which when we compare it to the 3% long-term inflation rate, it seems as this company is overvalued. Now, there are various risks and possible challenges that I do see, especially the worsening competitive landscape, with the new technology surging and a lot of competitors that are emerging in this space. They could modernize the solutions and offer a lot of competition to Verisk Analytics, so they have to actually pay attention and stay one step ahead of the curve. But the main objective that I see here is them not meeting performance objectives. And this goes for a lot of different reasons. First of all, they're trading at a high P/E ratio in comparison to their growth, and this is usually not a good pairing. It means that there are high expectations, and if these are not met, this can cause a big collapse in their stock price. But what I'm actually also seeing is that the way that they have reduced their assets by a lot more than they have reduced their liabilities can actually cause a lot of instability for the worsening of the balance sheet that this company has suffered lately. So now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage. They are generating consistent cash flows, although they're not growing, and they have high return on capital employed, which we do have to be careful here because it may actually be artificial and caused by their decrease in assets. Overall, I believe that this is a good company. I'm not sure if it would be a good investment, mainly because of its high net margin variability, but also because of its worsening in the balance sheet and the fact that it's actually trading at a high P/E ratio in comparison to its growth rate. But having said that, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.